Please note that I'm not a certified investment professional and this is not an investment advice. It is based on my research and personal experience. I'm calling this no-nonsense guide to mutual fund investing in India, and we'll be discussing in this short video about regular and direct investing. So there are two types of mutual funds, regular and direct. Regular has existed from the days of offline trading and it always has an intermediary involved. Direct was introduced by SEBI in 2012, and in this, investor directly buys from AMC's website. AMC is nothing but the asset management company. Now, I'm not sure why they have named the fund regular and direct, but my guess is when internet was not there, the only way one can buy funds was through an intermediary. In the year 1963, first mutual fund was launched by Indian government, and it was a monopoly of UTI. In 1987, more government institutions like SBI, Canara Bank, and others started their own mutual funds. And soon there was a deluge with private sector players getting in. So the regular is the original way and hence considered normal, where one buys the fund from an intermediary, which can be a broker, advisor, or distributor. Mostly if you're buying mutual funds using Demat account, you are doing a regular purchase. There are some exceptions to this, like the Zerodha's coin service. Direct mutual funds, where a retail investor like us can directly go to AMC's website or asset management company's website like SBI Mutual Fund, SDFC Mutual Fund, ICICI, Parag Parikh, and so many more, and buy the fund. Let's talk about parameters briefly. Cost. Since regular fund, there is an intermediary involved that needs a cut. Generally, the cost is higher than the direct fund. The next one is expense ratio. Every year, irrespective of how the fund returns, there is a constant expense for the fund houses, like personnel, server, licenses, and commission, which all become a part of expense ratio. We'll discuss few funds with expense ratios later on. Market research and advice. A regular fund is sold by intermediaries who have professional people who can choose mutual funds better than individual investors is what is normally discussed as a positive thing. Also, maintenance of funds from different companies is done on the tool provided by the intermediary, which gives an advantage as well. This all depends on the individual investors and how much time one wants to put in investments and basically their future. If one can spend some time to learn, doing a direct investment is a better option. NAV, net asset value, is what is calculated daily based on the underlying assets, and is always slightly higher for direct funds. Now here is a fund from SBI, SBI Nifty Mutual Fund. I've compared various parameters which you can see and between both the direct and regular. If you see these parameters, NAV of the regular fund is lower than direct fund even when the underlying asset or portfolio is the same. There is about a difference of 0.5% reduction in the return over the years. And the reason for this is total expense ratio of a regular fund is higher by 0.32% from a regular fund as AMC have to pay commission to the intermediaries. Let's look at another fund. Here is a Parag Parikh Flexi Cap fund, and the story is very similar. There is a difference of 1.15% between a direct and a regular investment. So what do we do then? You can see that it makes sense to invest in mutual funds in direct scheme, but one must develop basic understanding of how mutual fund works and then take a call. We'll discuss different mutual fund classification in the next video. If you like this video, please do like and subscribe the channel. Bye for now.